I'm Charlotte McLeod with investingnews.com, and here today with me is Rich Checkan, President and CEO of Asset Strategies International. Thank you so much for being here.
Happy to be here. Thanks for having me.
Really nice to be talking to you, and I thought, just since it's our first time speaking, if you could tell me a little bit about your background, how you got into the precious metals space and your work right now.
Yeah, it's a very common path to precious metals dealer. I was a West Point grad and an infantry officer with a pre-med degree. I'm sure everybody that's in the metals business goes that way. Yeah, of course. So the bottom line is I was in the military for about 6.5 years. I got out. I was doing direct sales, and my uncle and his partner had started a firm back in 1982, Asset Strategies, and asked if I could come along because they wanted to expand. So I joined them back in 1996, February, and I've been there ever since. So I came in as a client liaison, learned every aspect of the business, and very happily placed at Asset Strategies.
Oh, very good. And I like to ask about people's backgrounds because sometimes you do get a surprise.
A lot of twists and turns. I don't regret a single one.
Yeah. Okay. Very good. So one of the things I want to start by asking you about is gold and silver demand, what you're seeing so far this year, because interested to know what people are buying, who is buying, what products are popular. What thoughts could you share?
Well, we're a full-service precious metals dealer, right? So we deal with bullion, we deal with rare coins and world and ancient, but the world and ancient rare coins are a small part of our business. Primarily, our clients are interested in bullion. They want to get the most metal for their money with the least premium going into dealers' hands, and we're really good at that. So that's been what people have been after this year. They're looking for the way to get high premium or get a lot of metal, even though premiums tend to be high right now in our industry. I mean, silver eagles just came all the way down from 60% to 40%, premium, which is horrible. So people are looking for deals. In terms of overall demand, I would say that the first quarter was amazing. We did a lot of business in the first quarter. A lot of that was driven by financial planners that were driving people to us. They could not solve the physical metals answer for their clients. The clients were specifically asking for that. I'm sure a lot of that was driven by concern about banks. Things were going on in the first quarter, right? So a lot of financial planner referrals led to that business. It was a great quarter. Second quarter, I think people put a little too much faith in the Fed, and sales have kind of dropped off from the investor level. And we were talking offline just the other day, and I think part of what's propping up the gold price right now is central bank purchases, not the individual investor purchases. And I don't think they're going to get going until the Fed's done. I think they're pretty close.
Okay, no, that's really interesting. So, but you did see, at least during that time of banking crisis earlier in the year, people come in who may not have been interested before.
There's no question about it. People will still go to gold when they're concerned about the economy, concerned about the dollar, concerned about whatever their mother currency is. They are going to go to gold, and that hasn't changed. We saw that clearly in the first quarter.
Okay, and right now, though, it sounds like a little bit less demand, but premiums are high. So how does that work? Because I always associate the high premiums with higher demand.
Not necessarily. Sometimes the mints or the refiners or whoever doesn't really ramp up. They don't keep up with demand. They have a set distribution. Maybe they're at their limits and they can't do any more. I could tell you the demand is not off the charts, and it hasn't been. I've talked to a lot of other dealers. It's not just us that are having a tough second quarter. It's an issue. Investors have dropped off. The premiums were very high when back in the first quarter when everybody wanted stuff, and I don't know if the mints ever caught up. Now they're starting to. We're seeing the premiums gradually recede in certain materials, but all along the line, there have been products that are at reasonable premiums. You just need a good dealer to help you find them, right? So you call up someone you can trust. We're available, and we'll let you know at the wholesale level, and it changes from time to time what currently is available at a lower price. So.
Okay, all right. And just another note on the business before we get into what's going on in the markets. This is another thing that you started to tell me about, I think yesterday where we were talking offline about the Perth Mint certificate program that you have. So I wondered if you could go into that so we can understand.
Sure. I appreciate you asking about that. It's a neat program. We developed it 27 years ago for the Perth Mint. We worked in concert with them to bring it out. It's the first and still to this day only government guaranteed precious metal storage program in the world. So they came to us with a couple of problems 27 years ago. One, they wanted to compete in America against the Eagle, and Americans buy American. So we suggested they come up with a new product that nobody else offers, government guaranteed precious metal storage program. And if people buy into that concept, only allow Australian product into it. So that was successful, and that has worked. It's been a good program for that long. The other issue is they wanted to get out from under leasing costs. So they basically what we suggested is an interesting way of getting out from under the hand of the bullion banks. The way mints operate, they have to make up a whole bunch of things ahead of time, waiting for the world to come buy it in large quantity. But they need that working metal to make it ahead of time. So when you call to buy 10,000 kangaroos, they already have them made up and ready to go. They usually borrow that metal from a bullion bank with high leasing costs. And we suggested as long as our clients didn't care what form the metal was in, but they wanted 100% backed metal at all times, unique to them. They wanted no derivatives exposure. They wanted no leasing to third parties, and they wanted full insurance at full market value at all times. If we could deliver all those things, but not get hung up on whether it's a gold kangaroo or part of a 100-ounce bar or whatever, reward the client by not charging a storage fee. They gave up about 0.5%. Is what that costs for the physical plant and the insurance, and that was cheaper than the leasing costs. So they were able to save a lot of money over the years through the leasing savings. That's a win for them. The client wins because they get metal at 2.25% above spot with no fabrication fees and no ongoing storage fees. And I win because I get to offer that to people.
Okay, very interesting. Thanks for going into that. Yeah. All right, so we'll shift over to talking about what's going on in the market. So today is an exciting day. We got our latest Fed news. We got an increase of 25 basis points. I know that neither of us... Surprise, yeah. I know neither of us... We've been here at the Rural Symposium at the conference. We've been busy. We haven't seen what Powell may have said, but let's talk about that 25 basis point increase.
Yeah, so I think it's much ado about nothing. It was all expected. I expect still another. I don't expect much more beyond that. I think you asked me, when is the investor going to get into the market in terms of demand the other day, and my thought is as soon as Powell's done. And I think he's very nearly done. So everybody was we didn't have a chance to listen to his Q&A. I usually hang on every word and try not to retch. But I didn't hear it today. I assume he said, I'm really sorry for the American people and the pain of inflation, and we're doing everything we can to solve it as quickly as we can, and therefore we think we need to raise rates. And he did not show his hand as to what's happening next. From what I understand, the CME is expecting that they're done already. I personally think we have one more in us, rate increase for whatever purpose they deem necessary. And then I do think they're done, because I don't think they can service a $32 trillion debt at those interest rates. And as soon as they pause and then start receding, I think investors will get in the game, and I hope you already have your gold.
Yeah, and I think maybe now what people are starting to think about is, how long is that pause at the top? Any thoughts on that before we get to that reversal?
Yeah, I don't know for sure. I mean, I'm not going to look into his mind. I probably wouldn't understand it if I did. I just know that we're about done. And the biggest fear for gold buyers was how much more in terms of an increase in interest rates there was coming. I think we can see the end of the road pretty clearly from here. It's a dead end, and we're turning around. So whether that lasts a few months, whether it lasts deep into next year, it doesn't matter at all. I think the writing's on the wall. You get a few months on the pause, and it's almost just as good as a pivot, I think.
Yeah. Okay, good point. And, a lot of pressure is put on the Fed when it comes to reversing inflation. But I heard you mention in another recent interview the role of Congress. In other words, we have to have more fiscal responsibility as well. And I think that's not really
fiscal responsibility
any at all. And I think that's not often talked about, or at least not as much. So any thoughts you could add there?
Yeah, so it's simple. I mean, I've been very critical of the Fed. I don't like the fact that they get up and they say, we're feeling your pain, when they caused the pain. They had a hand in it anyway. They didn't recognize the pain. They denied the pain. They falsely diagnosed the pain as transitory, and then they were far too late in dealing with it. So I don't have a lot of love for the Fed right now. Although a lot of people think that they're doing a great job, I very vehemently disagree. That being said, they cannot fix this problem alone. They need Congress to stop overspending. Congress is spending more than they take in. That has been the case for decades. It's been off the charts the last two administrations. But both Democrats and Republicans are doing it. This is not a this party did it or that party did it. They're both to blame. They both need to be fiscally responsible. They're bad stewards of our money. As long as they overspend, Fed is forced with only two decisions: let the currency default or inflate it. They're never going to let the currency default. So they're going to inflate the currency, print more money. That makes every single dollar out there worth less. It eventually becomes worthless. So,
And even as we have these things going on, I keep repeating today, we have a lot of people out there who believe that the Fed will be successful, will have this soft landing. What are your thoughts? Because I imagine they're not in that line.
yeah, define success. I think there are already signs that things are breaking, whether they want to recognize them or not. The two biggest fears I have, and let me just say before I say this, that I am not a Chicken Little. I don't think this is the end of the world as we know it. I think we have real issues, and I want to stick my head in the ground and avoid them. I think we need to face them, and we can overcome them. So this is not the end of the world as we know it, okay? But we do have to change what we're doing. The things that I already see are breaking are one, personal debt, right? So I want to say credit card debt's over $1 trillion. It's been that way for a little while. And we're also seeing increased consumer spending. Why? Well, because products are more expensive. Okay, maybe inflation's coming down, meaning it's not climbing as fast as it was, but prices are still clearly higher than they were last year. Okay, let's not sugarcoat it. We're still paying much more for things than we did last year. And so things cost more, which means if you buy the same things, spending's going to go up anyway. But they can't, because we used to overspend as individuals and tap into our homes, our ATM, our piggy bank, and just refinance at zero interest rates and pull the money out, keep spending. Can't do that now. So people are now putting their daily necessities, my personal belief, onto their credit cards. That does not end well. Okay, that's one of the signs of the breaking that I see. We're seeing an increase in defaults on debt. The biggest one's coming. I think that's commercial real estate. Nobody's going to work. The buildings are empty. They're not getting paid. They're going to walk away. All right. These are no recourse in a lot of cases. This is going to have a major impact on the banking sector. I think things are already broken. Personally, I hope I'm wrong. I really do.
We'll find out hopefully at some point. I think we've been talking a lot about the Fed, but there's another point that I want to bring up. And that is this FedNow system that's been introduced. So that's been getting a lot of airtime, I think, at this event. And what I'm hearing from a lot of people is they're fine with this system, like as a payment system, that's fine. But the implications of what it means in terms of CBDCs, that is something people are not comfortable with. So what is your stance?
I think you know my stance. I think. Well, you know my quote. I think CBDCs were concocted in hell by Satan himself. So, and people, when I say that, they say, "Well, tell us how you really feel." I think they're pure evil. I think it's total government control over your finances and total lack of privacy for individuals. And it's not because we're hiding things. It's just, it's none of your business. I don't like CBDCs. I hope they don't happen. I think they're a train wreck that's going to happen no matter what. That all being said, FedNow is not a CBDC, right? So FedNow, yeah, and I'm all for a new, faster payment system. It's long overdue. I mean, Swift is so antiquated at this point. So I'd love to see that new rail in place. The only problem is that rail comes with that train on those tracks that's called the CBDCs, and I don't think we're going to stop that. They're going to sell it to us, that it's fantastic. It's going to bring the unbanked into the rest of the world. They're going to make payments very quickly. You're going to be able to pay your taxes very quickly. And that's all they're going to talk about. The bad stuff is going to get left behind, and the bad stuff is what's going to bite us later. I hope that they bring public and private sector people together. They have an open discussion, and they come up with real, meaningful protections into this new system. I don't think they're going to do that, but I hope they do, because this can be dangerous.
Okay, and so that's one of the things we've been hearing a lot about here. The other one that I want to touch on is the BRICS meeting that's coming up next month. So lots of different ideas about what we may or may not see there. Can you break down what you're expecting?
I think we pushed our enemies and our friends together, right? So by weaponizing the dollar, obviously the implications right up front, you think, okay, it's another way to fight the bad guys, right? So if they're doing bad things, we'll just cut them out of the worldwide banking sector, and they deserve it. The problem is our friends look at that and they say, okay, I'm on the good side of the ledger right now with the U.S., but what if I do something wrong? What if I misstep on purpose or otherwise by accident, and now all of a sudden I'm cut out of the banking sector? So they basically, our friends are being pushed away just like our enemies, and they're finding each other. So a lot of people have talked about this, obviously, and it is a wave that's happening. There are folks that are coming new ways to make payment systems or payments outside of the U.S. dollar for commodities and other things. The Saudis are basically walking away and saying, hey, the petrodollar was wonderful, but we're done, for the most part. And they're bringing others with them. This does not bode well for the dollar. I do think that there's some time before all that unfolds. I don't think this is happening tomorrow. Again, I think there's time to change the course, but we have to change the way we're doing things a little bit. As a nation, the dollar is very entrenched. Make no mistake, into worldwide finances, and I don't think it comes unraveled in a year or two. I really don't. I can be wrong.
Okay, so I think let's go back to gold now. And watching your presentation yesterday, one of the things you encouraged us to do is, zoom out, right? So if we, instead of looking at the day-to-day picture, so if we zoom out, we look at gold, where do you think we are in the current cycle? There's so many chaotic things happening right now.
Depends. So some people look, most bull market cycles, we've only had two of them since we decoupled from the dollar, right, in 71. But both of them were about 10 years long, right? So you think a cycle should be about 10 years long for a bull run. Where did that start, right? The low for gold was $1,050 an ounce in December 2013, I believe it was. So we're at 10 years, right? Are we done? I don't think so. Others will say, hey, what was it, like 2017, I want to say it was, where we finally broke out of that range we were trading in for a long time and got above $1,500 an ounce. It may be a little off on the timing, but that's probably about 6 years ago. So maybe we got another 4 or 5 years left. I think that and the Fed meddling probably extend this bull market. I still think we have to the late 2020s till we're done. And I think we still have a lot of work to do. I think it's been kind of dampened by the Fed actions and people's reaction to the Fed actions. I tend to think that we're going to see a doubling of the previous high. Previous high was 1920 an ounce back in September 2011. I think we'll probably get to 3,500, 4,000 before we're said and done. I think somebody asked me 5 years from now, where do you think the price will be? And I think it'll be below that, heading back down again. So in a bear market.
Okay, and we've covered some issues that are very topical at the moment, but in terms of drivers for the price of gold, is there anything that we didn't touch on that you have in your mind?
I look at two things when it comes to gold and where I think it's going in the future. I look at the dollar. I put up some slides yesterday with some inverse relationships. When the dollar was up last year, gold was down, and when the last 3 months, dollar went down, gold went back up, and in the end it was flat. I think that's a very real relationship that when there's confidence in the dollar and there's no confidence in gold, or no need for gold, and vice versa, at least in people's minds. The other thing is just keep an eye on the money supply. And I know we're talking about quantitative tightening. I do think that was what was happening last year. So when gold was flat, and everybody said it's not doing its job in an inflationary environment. I think they were wrong. The headline numbers of CPI and PPI were clearly inflationary. But when you look at assets, they were deflating as the Fed pulled the punch away from the party. It was a tightening cycle. Assets fell. Gold does its job in a deflationary environment by falling slower than the rest. So being flat last year was good enough to be 15% better than the Dow, 20% better than the S&P, 30% better than the NASDAQ, and 66% better than Bitcoin. So gold did its job by doing nothing last year. This year, I think we are seeing a bit more tightening, but I think the market is already pricing in the fact that the Fed is done. So we're seeing the stock market go crazy for what's coming after the next interest rate increase. And I think gold is holding back, but it'll join the party before long.
Okay, and I want to go back to that deflationary versus inflationary point because I heard you mention that yesterday, and I don't think I've heard that from anyone else before. So can you go into?
Yeah. So again, when I talk about CPI or PPI, we're talking about the consumption end of things, right? So clearly that's inflationary. Dollars aren't going as far as they used to when I'm trying to buy tomatoes or gas or what have you. But when I look at asset values, that's what has been inflationary. I mean, the stock markets have just been flying up for years and years. And all of a sudden they about faced and went south. They were shedding value, deflating. So I look at when you're in a tightening cycle, right, where we're getting less liquidity, that the markets will drop in value and assets, not consumables, but assets are deflating. And I think that's what was going on last year.
Okay.
I think gold did its job really well last year, by the way.
Yeah, yeah. Well, and it's so interesting just to hear you explain the different data points that you look at because it seems like there are many different options for what you can keep in mind.
But for me, it's all about the dollar or any other fiat currency that you measure gold with. If it is mismanaged, there's no question when you use it to measure gold, gold's going to cost more in the future. And that's the cycle we're in, the cycle we've always been in.
Okay. Okay, so we're coming to the end here, and I want to ask if you have any final advice that you would leave investors with. I think we've talked about so many large concepts, and if we had to relate it back to something that people can take away and hopefully use to their benefit, what would you say?
Well, I think if you haven't shored up your allocation to gold for wealth insurance, it's time. I fully believe we got maybe one more rate hike in us. I don't know when it's going to come. I think within a month or two. If it does, then that sets up really well coming out of the summer doldrums when we tend to see more physical buying activity in the fall, largely because you're seeing jewelers buy for end of year holiday season. They're going to make more jewelry. You see people getting back to work from surf and sand and paying attention to their finances. So you just tend to see more buying with precious metals. You got the wedding seasons and so forth where gold consumption goes up. So I think you're going to see in the fall an increase in gold prices anyway. If we have that final rate hike and then a pause, I think it's just going to accentuate it. So that being said, I don't think you have to rush out tomorrow and all this, it's too late. You didn't buy your gold, you're done. Buy it slowly, buy it over time, but fill that allocation for your wealth insurance. I think you're going to need it in the future. I hope you don't. I like you heard yesterday, a 10% allocation for wealth insurance. That's a store of purchasing power with high liquidity for a potential financial crisis you hope you never have, and I hope you never have it. You want to buy that, hold it, and really hope that it does nothing, absolutely nothing, and 90% of your portfolio takes off. But in case it doesn't, you want to have it, and I think you want to start accumulating it now.
Okay, well, thank you so much for coming by to share all of your thoughts on what's going on with gold, the markets. Really great to have you.
Yeah, thanks for having me. I hope to be back. It's very comfortable, and I think there's a lot to talk about.
There is so much more,
It's
there.
not the time to stick your head in the sand.
No, no.
It shouldn't be prudent.
We'll have you back, and there are certainly so many more things to talk about.
Wonderful. Thank you.
Of course. And once again, I'm Charlotte McLeod with investingnews.com. This is Rich Checkan with Asset Strategies International. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.